presenter is Richard Gordon, who is the president and CEO of Gordon Energy Solutions, who will be talking about the lessons from Statoil.
You can see from our title what we believe is one of the fundamental lessons from Statoil's experience, namely the concept of political entrepreneurship. This is something of an invention on our part, but the point of the fact is that it's actually an invention of the Norwegians. And I think it's something we need to look very carefully at. Okay. There. First key point is simply this. In the course of really only 35 years, Statoil and the Norwegian petroleum economy have gone through a phenomenal process of evolution. That evolution, in point of fact, began with the absence of a viable oil and natural gas industry and has ended now with Statoil basically merging with Hydro to form a new global competitor. In the process, what we've seen in the Norwegian environment is a startup and evolution, post-adolescence, which we characterize as the emergence of functional competitiveness, then privatization, Statoil after the merger. These are the key stages that have occurred. Up to this point, Statoil's evolution has largely been a function of the evolution of the underlying resource base. I don't think they're unique in that respect. I think that's a common and a shared feature. To highlight that point for just a moment, if you take a look at this, whoops. Okay. The perennial problem. Now how do I go back? Push it up. Ah. This graphic shows in the shaded area the cumulative resources discovered in Norway in millions of BOE. The line graph shows the average field size of discoveries in Norway. And I want you to note in particular, we've highlighted several key stages of Statoil's evolution. Most importantly, I want to highlight 1990 for just a moment. But in particular, notice the rapid explosion of Norwegian petroleum economy, followed by a clear and unambiguous deceleration, a maturation, if you will. The challenges confronting the NOC change as that sector changes. And one key element of success for an NOC ultimately is its capacity to evolve with the sector. 1990 I highlight because in that year, Statoil formed a joint venture, or if you will, an alliance with BP. It was an upstream alliance, and it was specifically designed to build Statoil's international presence. So as early as 1990, there was a clear move towards strategic alliances, much like what have been discussed earlier today. Statoil was a leader of that. Ah, I did it again. Okay. With that evolution, ladies and gentlemen, has come an evolution of the functional roles that Statoil has played. And in point of fact, we've highlighted here both the character of the roles and the relative importance of those roles in Statoil's behavior. If you look vertically, up and down, those goals at the upper end of the graphic are more economic in nature. For example, economic development, wealth creation, even a national energy policy contribution. On the bottom, we have the more political goals. Those can be foreign policy tools, but most typically are talked in terms of wealth redistribution and regulation and management. Now, I want you to notice that in the initial stages of Statoil's experience, that is 1971 to 1981, They were responsible for both providing social welfare, economic development, regulation and management, and wealth management. So they had a multitasking function that they had to perform. It was relatively evenly split at first as well. There was a great deal of expectation from the company. As we move, though, to 1981 to 2001, that's the era of functional competition. That is, Statoil is a functional now competitor in its own right, in its own home territory. During that period, notice the role of regulation and management diminishes very rapidly and very substantially. Social welfare functions begin to fall. You see a much heavier emphasis on economic development and wealth management and creation. This focusing of the Norwegian policy goals as they applied to Statoil is a critical step in their country's development and in Statoil's development. And then last but not least, we see now in the final stage where quite literally Statoil's primary function is almost overwhelmingly wealth creation. It's a critical step that has been made, one that many NOCs are right on the verge of making themselves, in our opinion. That step was the capacity to, in point of fact, be a competitor at a global level. That is, the NOC has become a tool for economic policy far beyond the domestic petroleum sector. Whether the government chooses to exercise that tool or whether the government chooses to allow it to preside over a deteriorating or declining industry is the question. The Norwegians' choice was quite clear. This is a tool, we will use this tool to create wealth internationally. So I think it's a very interesting and very important step for them. Sorry. Even when I think I've got it, yes, I do. Let's talk a bit about some lessons that I think are pretty evident, in our opinion, from the Statoil experience. Norwegian culture, I've worked with the Norwegians for many, many years, thank you. For many years, in fact, since 1981, in one form or another. They have always combined this incredibly pragmatic mix of social democracy and entrepreneurship. It's an extraordinary capability. Now, if this is what we call political entrepreneurship, in point of fact, if this was purely a cultural strength of the Norwegians, there'd be no point to even mention it. I don't believe, and I believe my colleague who helped write this would agree, we don't believe it's a cultural result. We believe it was a political decision and it was a policy decision that flowed continuously through multiple phases and multiple initiatives over time. We also believe that these policy choices, with proper adaptation, can be applied in multiple other countries to achieve the same result. See if I can get here. So let's talk tactics, the nuts and bolts. How do you get there? First and foremost, there is a critical and essential benefit to be gained from a focus, a consistent long-term focus on wealth management. There is a clarity of purpose and of means that comes with that. And I believe the Norwegians have practiced that almost religiously throughout this whole period. That means then that there's a limited non-commercial policy interference in the NOC's operations. That's an essential part of that almost single-mindedness. Also, it means that competition, or in the Norwegian case, it has been shown pretty clearly that competition is a value-adding force. The degrees of competition that Norway created are so manifest, so manifold rather, so many, right down to the point where as their sector developed, they and the British were in direct competition for capital from the first. I am not meaning to suggest here that there is only one goal or one role of public policy as it affects energy in any country. What we are suggesting is that what contributed to the success of Statoil was in no small part the fact that the Norwegian government from the very beginning saw the NOC as only one of many tools to achieve its ends. Those other tools included taxation, a licensing strategy which drove my former employer, Phillips Petroleum, crazy because they controlled and tried to limit just how much competition there would come in and who would dominate. It included the role of the Petroleum Directorate as a regulatory agency. All of these tools working at the same time. And last but not least, the NOC and government energy policy in the Norwegian case, and we suspect in many other cases, ultimately was an evolutionary or adaptive organism. So we come back to this point of evolution, the capacity to respond to change and to use the many, many tools at their disposal to make that happen. But at the end of the day, we still look now at a situation where Statoil, with the merger with Hydro, is now of a class, on the edge, not of the class, but on the edge of a class of global competitors. They aspire very seriously to succeed at being that. My own suspicion and my own expectation is that there will be multiple NOCs that make this transition in the coming years. That in point of fact, now is the time for many NOCs to follow this pattern. Thank you.
For this session is Don Hertzmark, who is going to talk about the high cost of subsidies and mismanagement in the Indonesian sector.
Guest, thank you very much. It's a pleasure to be here. I know that our program is running behind time, and I do not want to stand between you and caffeine, or between you and our excellent speakers who come right after the break. So I'm going to try to keep this quite short and sweet if I can. In the case of Pertamina, what we have is a company that was, like many NOCs, a multifunction company. The owner of the representative of the government's ownership of the resource, the regulator of the sector, a producer in its own right, the king of the hill in Indonesia. Today, they're one of the guys. They had a special law. This law was different from the other state-owned enterprises, and the Indonesian government looked at Pertamina as playing a major role in national development. But we haven't reached the financial crisis yet. Okay, so really, they were a pioneer for many years. Production sharing contracts were one of the innovations in Indonesia, a structure of the LNG industry that was unique and allowed a lot of remote gas in Kalimantan and Aceh to be mobilized. And the structure was so attractive that Petronas, which we all think of today as an extremely successful NOC, very consciously copied the Pertamina structure. The company made a lot of money for the government, especially once LNG started flowing, and they acted as an investor and as a regulator, people who went to Indonesian conferences would hear the phrase, Pertamina and its production sharing contractors have done the following. So it was always very much Pertamina and the companies. They controlled the key downstream assets, even though they did not own most of them. This is still a matter of significant controversy in Indonesia, and it has significantly blunted the effectiveness of sector reform in the country because it's extremely hard to invest in something or to sell something that you don't own. And it represents an ongoing struggle that many of the case studies noticed that it has happened in Venezuela, Iran, and elsewhere. In Indonesia, it was called the nationalists versus the technocrats, or the nationalists versus the Berkeley Mafia, but two different approaches to how national resources should be used for economic development. In the middle of the 1970s oil boom, Pertamina had a major financial crisis when they decided that owning shipping companies, airlines, golf courses, hotels, and numerous other properties was more fun than being in the oil business. And at the time, they were able to produce their way out of this crisis, something they could not do 20 years later when they got into a similar-sized crisis in the 1990s. Throughout the 1980s, with better macroeconomic management, they became a major exporter of LNG. This LNG, obviously, from places that were at the time not accessible to the rest of the country, meant that they could monetize these remote resources. They managed a modest decline in oil output, which peaked at 1.6 and was still, as recently as about 7 or 8 years ago, still in the 1.3 million barrel a day range. And then they were so successful with their macroeconomic management, so many people had access to automobiles, that a fuel subsidization program, which began mostly as a way to allow rural people without access to electricity to use kerosene for lighting and cooking, suddenly turned into a monster. By the late 90s, by the time the financial crisis hit, subsidies, and this is, as you remember, the 90s, this was low oil prices. Subsidies were taking about 25% of the government budget. In fact, it was so large that even when the country was physically a net exporter of oil still in '99, the financial cost of the subsidies meant that the oil sector, not gas now, but just oil, was a net financial drain for the Indonesian government. So well before the country ceased to be a net exporter of oil, that was 2004, Indonesia had ceased to get net economic benefit from its oil sector. In 1997, whoops, come on, there we go, one more. Okay, in 97 and 98, it became clear to people when the financial crisis hit, Pertamina was part of this problem. Subsidies were certainly part of the problem, but mismanagement and corruption at Pertamina were also extremely important in this. It cost Pertamina 2 to 5 times as much to drill a foot of upstream of production activity than it cost the production sharing contractors. And the IMF performed a special audit, and in the aftermath of the fall of Suharto, with a relatively free press, while quotes from the audit did not make it to the press, the gist of it did. And what the gist of it said was that something in the billions-dollar range per year was flowing the wrong way out of Pertamina in most of its activities, the activities where it represented the government, the activities where it was refining oil. And so it was clear that Pertamina's emphasis on and the government's emphasis on social functions and on subsidies had caused Pertamina to lose focus, and ongoing corruption, of course, very often causes a company to lose focus. Two good prospects, Natuna and Cepu, both of which could have been developed years ago, continued to be a subject of controversy. And it became an article of faith among reformers, and this is the most important point, and this was not an economic or financial issue, but Pertamina had to be reined in, and this was the key to the reforms that followed. The Oil and Gas Law of 2001 was really the end of the marriage between the government and Pertamina, and it transformed the role of Pertamina to a normal company, but reducing subsidies made scant progress. The subsidies would be reduced for a while, the process would be stopped, the subsidies would go back up to 25–30% of the government budget, and Pertamina, in many ways, wanted the subsidies to continue because as long as the subsidies continue, they have no competition downstream. Nobody wants to buy refineries that sell subsidized products, and nobody wants to invest in them. So, production was continuing to fall. As I said, in 2004, between the subsidy-fueled increases in consumption and the declines in production, the country ceased to be a net exporter of oil. The gas sector now threatens to replicate the experience in oil. Falling production in the main LNG centers was probably not necessary, but the reform process itself has not been implemented all that well by the Indonesian government, and as a result, it has resulted in a decrease of about 4 million tons a year in LNG exports. Indonesia, once the largest LNG exporter, I think is now, I think as of today, number 3. And subsidy-fueled demand for refined products, every time you think the program is ending, it doesn't quite end. There's another $5 or $6 billion this year that they have to put into subsidies. So oil and gas doesn't fuel Indonesia's march into the industrialized ranks. What are the lessons here? If you subsidize something, people will want more of it. No, well, you know, you laugh, but sometimes people don't think that way. You can't sell shares in refineries that you don't own. This has sterilized the whole investment in the downstream sector of the country. And the upstream lessons are very much that Indonesia has decades of mixing regulations, fiduciary functions, and the lessons for Petronas and CNOOC and others are that if you're going to mix these functions, you really have to make sure that you have proper separation of function in your organization so that you do not end up with an inappropriate mix of activities and motivations. And controlling subsidies once they have become a right is extremely difficult to do. And so, once again, in countries where you have rapidly growing demand and you have heavy subsidies, the time to take care of this is before you think you need to. Thank you very much.
Any questions? Okay, I think we'll proceed to a short coffee break before we have our final session. Okay, we're going to get started with our final session. So in our final session, we are going to look at some sort of broader aspects of the strategies of NOCs, and our first speaker is Alexander Oliveira, who is the Global Upstream Lead Partner for Accenture. His work focuses on strategy, process, and performance improvement in the oil and gas industry for clients globally, including national oil company transformation projects, frontier area petroleum marketplaces, national content development, high-performance asset management, and capability and capacity development. Alexander?
Well, right about now, I'm very pleased that I don't have any slides, so we won't have to navigate the slide projector. Also very pleased that Tiger Woods, as you probably all know, you see him on the ads from Accenture, has decided to do some investments in Dubai, so that's a sign of the times and a very positive thing from his side. And of course, as you know, he personifies high performance, so we're very pleased and honored to have him work so closely with Accenture. The second point I wanted to make is that it's very rare, in fact, that you go to conferences these days and hear something new. And I was very pleased, particularly with what I heard this morning regarding high-performance attributes and NOCs, and what I heard this afternoon around some of the case histories, that we hopefully will walk away with some new ideas about how to create better collaboration between IOCs and NOCs. So on behalf of Accenture, I'm delighted to be here, share our perspectives on how IOCs can respond to increasing global reach and key imperatives from national oil companies, as well as to share some new collaborative processes and methodologies, some of the projects that are being implemented around the world to create and drive value in local economies. About a year ago, Accenture presented the results of its own national oil company study at CERAWeek in Houston. And in our conversations with various clients globally, it was clear that NOCs and IOCs have very different perceptions about one another. This is essentially what led us to undertake a study and to identify a disconnect in terms of how NOCs thought they were doing in accessing reserves and building relationships, and how they were actually doing from the point of view of the NOCs. Also, in our study, we wanted to understand the ingredients for good partnerships between IOCs and NOCs. So we could simply have asked a selection of NOCs what they thought, but we also polled IOCs to try and create that collaboration and that partnering spirit. We interviewed about 13 NOCs and we profiled 20 companies. We selected NOCs that were resource rich and resource poor, and we interviewed NOCs in all geographic regions. Some were focused on domestic issues and others were international players, so we had a good cross-section. We also reviewed findings, again went back to them regarding what they had said to us in the interviews and what we had found in the profiling, and just validated once more that the strategies indeed that were communicated to us were clear and that we had a good understanding and alignment. A lot of the, in fact, findings have been reflected in this study, with some new elements being added, and we also then entered into an implementation phase of some of this learning with several international oil companies, helping them become more successful in various countries around the world. And so we're going to share with you some of these findings. So the context basically around changing energy dynamics, and the dynamics have changed dramatically in the last few years. I don't need to tell you that. 10 years ago, industry was rapidly opening up. IOCs were thinking about merging and merging. They wanted to be able to better compete in the global upstream market. Today, many of those mergers have taken place, not to say that there aren't more to come, but competition has become far more intense than it's ever been in this industry. And it's primarily competition for assets, so access, for people, and for equipment. And the win-win that we've seen typically is created through a balance of local and global value drivers across IOCs and NOCs, much like the experiences of transformation in other industries, responding to rising demand, responding to globalization, and responding to various changes that we see happening around the globe, including geopolitics, of course. So as traditional energy supply areas have become more mature, international oil companies are looking for reserves in frontier markets. That came across very clearly today. When you look at risk profiles, stability or lack thereof, we're going to see in the future energy portfolios that need to be a lot more sensitive to risk issues than in the past. Access to these new reserves is, of course, primarily controlled by national oil companies and or resource holding governments. These NOCs have transformed quite significantly in the past few years, and certainly in the last 10 years. Some are competing internationally. They're very confident, they're asset hungry, and outward looking. They have higher expectations at home as well for greater economic value and benefits, and most are concerned about the development of their economies, having seen, for example, the Norway model, which many speak of as being a particular good way of deriving economic benefit and creating new industries. So we also see the return of resource nationalism in places like Latin America, and we see almost all NOCs being cash rich. But more important than that, we see examples of well-executed strategies that center around collaboration and alignment. And how to achieve that is going to be a topic of my discussion here. So we're in a situation where the competitive landscape definitely has changed. The cultural and business drivers and business imperatives, however, have not kept pace. We still, attend various meetings and think tanks and discussions with companies that have not quite adapted to the new realities of competition in today's environment. And that competition, of course, presents opportunities for them and opportunities for the industry at large. So with high and sustained energy demand, the good news is that IOCs and NOCs will need each other and have to work together to serve that growing demand, and they will have to work together to benefit local economies and their people. So what is the NOC agenda? Let's start there. Much has been said about the increasing power and maturity of NOCs. We've particularly seen the Asian companies becoming more international, more aggressive in their bids for resources. We're seeing a number of NOC consortia, and they increasingly prefer to make deals with each other, much to the concern of some of the IOCs, often leveraging government-to-government relations. And the culture of alignment that exists in some cases between those countries. There are several factors positioning NOCs to compete for assets more effectively. First of all, they've raised the game on their technical capabilities. This is reducing their reliance on IOC expertise. Not completely, not entirely, but generally they are less dependent on technology from IOCs. Over the last decade, IOCs in some cases have underinvested in technical capability, leaving the major service companies to step into that void and now become pseudo-oil companies and advisors to NOCs on technology matters. Secondly, NOCs are moving outside their domestic borders into international arena. Number of value of deals NOCs are undertaking has been increasing dramatically since 2000. Also, national oil companies have become successful in making deals globally because they're willing to invest downstream to access assets upstream. So they're playing across the value chain. So with the sustained oil price, any doubt about the ability of NOCs to finance their own deals has effectively disappeared. Many NOCs are semi-privatized, listed on key stock exchanges, and adhere to the same financial controls as IOCs. In fact, at the recent CERA conference, the presentation from Petrobras was one of the discussions that got the most interest, and to see how far that national oil company has come in the last few years. So they're combining good financial management, the ability to self-fund many of their operations, and in some cases, the ability to rely on the support of their governments in their international and national expansion. Many NOCs also strengthen their governance and independent decision-making, which of course is one of the key attributes for a high-performance NOC and has helped them along the way. Characteristics of this new type of collaboration include flexibility, cultural alignment, responsiveness, as well as sensitivity towards local economic needs. And in that context, some of the NOCs really need to step up their game in terms of creating better alignment and challenging so-called common sense that we hear being mentioned as reasons not to make certain investments that in the long term actually do create a win-win. So where does this leave the IOCs? It sees them coming face-to-face with NOCs more often, not only as customers, partners or custodians, but also as commercial competitors. Technology and capital are no longer sustainable differentiators, as all the leading IOCs can offer the NOCs have the access to this and more. So what can IOCs do? What's the IOC response in this new world? Well, Accenture believes that one of the most fundamental steps is for IOCs to invest the time to truly understand NOCs and their priorities better. In the past, there has been a one-size-fits-all type of approach and mentality, trying to group NOCs together. And in fact, one of the findings of the study, not unsurprisingly, is that they're all different and should be handled as such. They have different objectives, governance structures, and styles. For example, when we did the study, security of supply and revenue growth did not rank in the top two as a priority for NOCs. Many of the resource-poor NOCs are focused on meeting the high demand of their domestic markets and opening up their downstream. They're hungry for suitable assets abroad in return for downstream access at home in some cases, while others are focused on specific priorities such as gas, deep water, or LNG project skills. Another key finding was that NOCs are tending to adopt a very project-based and transactional mindset when dealing with IOCs. And in many ways, paradoxically, IOCs encourage this transactional versus a relationship-driven mindset. So there's a lesson learned and room for improvement in that area. Finally, NOC has also told us they want to play across the value chain, and we have seen evidence of this in many cases recently and ongoing at the current time. So based on these findings, one clear priority stands out, which is that to be successful, IOCs need to differentiate themselves, and not necessarily along the lines of risk or financing or technology, but along other parameters. How can they do this? The first way would be for IOCs to understand the individual NOC and priorities and develop a strategy that is specifically tailored to that NOC and the nation that NOC belongs to. They need to think of the NOC as their client. And it might sound obvious, but in many cases, when we see in the dealings that we have between IOCs and NOCs, that client mentality is often lacking and creates some issues where engineering becomes the primary driver rather than some of the other areas for alignment. So this approach will result and has resulted in the cases that we know of in much better alignment and greater success. Also, to create value, we need to meet the compliance needs of both sides, IOCs and NOCs, and to differentiate in that area. And at the heart of this is setting up a win-win. This includes methodology and a series of value-enhancing work streams that make sense in terms of the relationship between the two parties. IOCs also need to be more flexible and prepared to be more creative in deal making. One of the areas of creativity, which is much talked about now, is the area of asset swaps that until very recently was not very prevalent. And what we say is that the opportunity for NOCs and IOCs to acquire assets that are off the market and will not be traded openly create a great opportunity for enhancing value on both sides of the equation. So IOCs need to deal with NOCs as part of a long-term strategic relationship, and this deal should aim to broaden local content for that nation. We have some very good examples, Brazil, Azerbaijan, Trinidad, Angola, and in fact also Nigeria now, that are running some very strong and very beneficial local content programs that seek to redistribute wealth, seek to create service companies within their sectors, and also target indirect jobs in the industry, not just the direct jobs that we hear mentioned. So Brazil's program is called ProMimp, and they have a website that describes that very well. And Nigeria has just kicked off its initiative and already having some benefits from it. So increased local sourcing, we also believe, is one way of reducing costs, not always perceived that way, and creating economic wealth for the country. And we have very good examples, Azerbaijan, where where the NOC and BP in this case got together and identified ways to reduce procurement costs, whilst at the same time channeling more dollars into the country. So despite the presence of well-developed national content programs, the measurement support and tools to sustain them, use is still not as widespread as it should be, and many NOCs still do not have a sustainable and well thought through national content strategy. And this makes it difficult in some cases for IOCs to interact with them. So there's work to be done on both sides of the house. In many projects today, the basis of competition is also around operational excellence and delivering the basics of the business more efficiently and effectively. This has been challenging for some NOCs facing decreased experience within their workforce. So again, there are some creative solutions being worked on now in order to reduce the bottlenecks in terms of engineering expertise, fabrication capacity, that create also a better alignment between IOCs and NOCs. So to reach some conclusions, the emerging competitive landscape will see IOCs face NOCs on two fronts, in international markets and in their own nations. To collaborate as a partner and to bid against them as a competitor requires a clear understanding of their priorities. NOCs continue to value the IOC's project management, integration and gas industry capabilities particularly. They encourage the presence of IOCs in their markets, which can also send a signal that their country is really opening up. And in turn, IOCs need to improve alignment and their countries around the country's economic imperatives. High oil prices are increasingly empowering resource-rich nations to extract more value from the future. If IOCs want to be part of that future, they need to start talking a different language, which includes words like client, collaboration, oil funds, social responsibility, and economic development. And NOCs, in turn, need to create a consistent, clear, and transparent framework for interaction to extract optimal economic benefit. So finally, partnerships can be built around complementary capabilities, and in the words of one INOC, partnerships are sought in the area of risk mitigation, access to markets, access to proprietary technology, with the emphasis on proprietary, political strength, and government-to-government relationships. And let us not forget that we are doing this to benefit people and stakeholders both globally and locally, and fundamental to this is education and training, as well as healthy global and local enterprises operating to the same standards. Thanks.
Presentation is going to be by Thomas Langford, who runs the Global Energy Group for Morgan Stanley. He is going to talk about how IOCs and NOCs are valued in markets, and I think you'll all be interested to see his slides.
First, let me thank the Baker Institute for giving us a chance to share some views with you today. The topic of my discussion is how the capital markets view national oil companies. I think you've heard through the course of the day that there are a lot of differences among the various national oil companies in terms of strategies and behaviors. Various speakers have discussed the structural changes that are occurring in the energy industry. But if you take the perspective of an international oil company, whether it's falling reserve replacement, rising cost, or flat, or in some cases, declining volumes, these are all symptoms of one underlying cause. And that cause is that energy is migrating to emerging markets, and therefore the resource holders, the national oil companies, progressively have the advantage. The equity markets have been quick to recognize this, and there's been a migration of value to the emerging markets over the last 4 years. But there's also a more interesting suggestion that the winners of the last century will not be the winners in this century. To be more pointed, if the supermajors were the winners in the past, will they still be the winners going forward? Or to put it another way, is the supermajors a 20th century concept? I'll start with 4 observations that suggest that things have changed. Maybe. There we go. This chart, and I apologize for the scale, it's a little tough to read, but it says something pretty important about how the markets have viewed and valued the international oil companies. This chart plots since December 2004 the share price performance of the different subsectors of the energy industry. The IOCs are the green line at the bottom, and you can see that their overall share price appreciation has been in the range of 30% versus the national oil companies, the purple line, at around 150%. The market's become much more concerned about absolute performance and relative performance, and investment has become more global rather than regional. As a result, investors are looking for absolute performance from a much broader range of companies. Furthermore, although investors have always had the choice in their portfolios, the sheer dominance of the market cap of the 5 largest supermajors meant that these were the critical decisions. Today, with 14 companies in global energy with a market cap of over $50 billion, they're not only a large number to choose from, but both IOCs and NOCs, but a large-scale portfolio investor has real choices as to where to invest his money. The point is that the IOCs are not the superstars they once were. That's a change, and this next chart shows it in a slightly different way. There we go. Here we plot from 2000 through projected 2008 the price-to-earnings multiple of the international oil companies versus the mid-cap integrateds, E&P companies, and the national oil companies. The point is the IOCs, which is a green line, used to enjoy a big premium multiple valuation. You'll all remember the dawning of the supermajor with the promise of the inherent scale, technological advantage, capital, and clear partner of choice for the NOCs, which was meant to lead to a sustainable valuation advantage. Well, as you can see from this chart, the premium valuation enjoyed by these companies in the early 2000s is no more. Everything's leveled off. But more importantly, look what's happened to the NOCs, the purple line. If anything, they now trade at a slight premium to the IOCs. That's a big change. Something's clearly different. Now here's the third change I want to call to your attention. This chart shows the capital markets attitude toward emerging markets generally. Here we track in the green line the performance of the emerging market equities relative to an index of world equity market performance, and in the red line, against the reverse scale on the right-hand side, the spread on emerging market bonds, which have steadily tightened since mid-2003. The point is, investors, the world capital markets, are now much more comfortable than they have been with emerging market investment risk. Said another way, risk has been re-rated across markets. This re-rating of risk has substantially added to the momentum of not just emerging market stocks, but to higher risk stock within developed markets. Or putting it another way, the premium for blue chip has basically been eroded away. Obviously, trees don't grow to the sky, and emerging market risk will no doubt weigh back into the market. But in the meantime, the re-rating of risk has had a positive effect on national oil company valuation, and it also serves to reduce the cost of capital in fueling and funding growth opportunities. Let's put these first 3 observations together in the next slide and see what it means to the energy universe. This chart shows in 2 ways the composition of market capitalization in the energy industry. On the left, we show in absolute numbers the market capitalization represented by each of these subsectors. The bars are rising as the values have gone up. But note in particular the rate at which the NOCs, the green bars, have risen since 2001 relative to the much slower rate of increase of the IOCs, which are the red bars. Highlighted on the left, where the same numbers are shown in percentage terms, again, the contribution from national oil companies has changed dramatically, from representing around 13% of total energy market capitalization in 2001 to 38% in 2006, while at the same time the IOCs have shrunk from a dominant 70% to around 40% today. So something's changed in the market, that's for sure. Now, what are the industry realities against which this is happening? The first is cost. I think we all know and have seen similar charts. But in this particular, on the left-hand side, cost is represented by finding and development costs have risen considerably since the late 90s. Furthermore, I don't know of any oil company that sees finding and development costs declining from current levels. And also, the complexity and size of projects the industry is taking on is on the increase. Non-conventional projects, including oil sands, LNG, GTL, heavy oil, or very deep water, are among the most expensive projects undertaken by oil companies. Just using the projects we know about, these move from representing 14% of production in 2003 to over 22% of production in 2010. Also, given the sheer scale of infrastructure associated with many of these projects, there's an increase in the level of single project risk within IOC portfolios. Eni with its Kashagan or Shell with Sakhalin are probably the best examples. But of course, the real story has been the resource base. Here are the familiar charts about reserve replacement on the right, and the idea that the old mature basins have been worked and reworked and that the returns are diminishing. Access to resources is now the single most important issue for IOCs, has been discussed by many speakers today. And although declining throughout the period shown, reserve replacement was in fact relatively healthy until a few years ago. However, this really masks the longer-term trend for oil companies. The healthy reserve replacement that we saw before the decline set in was largely a function of the upward revision of existing assets. That's the right-hand side of the chart. It was not the result of increased access to new areas. The oil companies are not getting worse at finding new oil and gas. The current difficulty in accessing genuinely new resources has existed for some time. It's simply that the oil companies managed to overcome or delay this difficulty by using technology or better field and cost management to extend the reserves of the fields that they already discovered. These are the challenges being faced by the IOCs. The 21st century is clearly not like the 20th century. As we start thinking about who the winners will be, we need to look quickly at some 21st century realities. First is, where's the growth going to come from now? Whereas before, in the last period, and we've shown that from the period of 1975 to 2004, the category Other constituted the bulk of the production growth. Within the Other category, the single largest contributing area to world production growth was in fact Western Europe, with the discovery and development of the North Sea in particular. Even during this period, the IOCs had less access to resources, as the majority of the resource-holding nations excluded them from their production. However, they had adequate alternative opportunity sets and developed substantial OECD asset bases, which are still generating the bulk of their earnings and paying the dividends today. Now, according to EIA, OPEC and the former Soviet Union will dominate as a source for future production growth, and unfortunately, it's precisely in these areas that the IOCs have had the greatest difficulty accessing resources. And here is another thing we all know. The resource base is really in the hands of OPEC, and in particular the big 5 OPEC countries, which leads us all to being very much aware of the emergence of national oil companies in general. And as we've heard from other speakers, these national oil companies are not just developing their own country resources, but many of them are actively competing on the world stage for additional resources, all of which is leading to a much higher level of competitive pressure. There's no question these NOCs are capable of operating in the international arena. And there is clearly still a role for the IOCs, but they must compete with ever more sophisticated national oil company competitors, some of them with the explicit support of their government. And here they are. Many of them are the focus of the Baker Institute studies, but clearly the NOCs dominate. I think the capital markets recognize that many of these NOCs have the resource base for sustainable growth, attractive cost structures, technological sophistication and scale. But this isn't another way of getting to the question of resource nationalization. My point is slightly different. It's to suggest that from these companies, despite the politics and issues of sovereignty surrounding them, there may be a few that emerge as recognizable to the markets as super NOCs, the replacement for the super majors as the oil company of the future. I want to finish by going through some criteria I think will define this market-friendly NOC, but first let me spend a minute on why it hasn't happened just yet. What's interesting to me is why, with all the NOCs that now have public shareholders, that this hasn't happened yet. Interestingly, I think it's still partly mindset, with the tendency of part of some NOCs to apologize to the markets for not being private. I think another reason is that investors still don't recognize the category yet. But also there's a lack of awareness of what's needed. What you see on this chart is a list of other causes, which include political will, commerciality, concern with access to capital, government bureaucracy, inwardly focused cultures, lack of initiatives, and I'm sure there are many other plausible reasons. But we believe that's changing, and companies are now having to face markets, which leads to the question of what will be the criteria for the super NOC. Here it's anybody's guess, but I put together some suggestions on this slide. I think it's broadly going to be about acting as the interface between the majority shareholder and the rest of the stakeholders. It hadn't happened yet, but it's coming. And I think when it does, we'll all recognize the oil company of the future has arrived. Thank you. is do we expect the NOCs to take over the IOCs, and do we think, or some of them, and do we think that there's a political will? I think that there, as has been discussed already, there are a number of different forms of cooperation that I think we're already seeing emerge between NOCs and IOCs. I would further just state that, at least from our perspective, when you think about the transactional activity that we've been involved in on the part of IOCs, in many cases they're looking to acquire very large asset endowments to the extent to which it becomes 20, 25, 30% of their portfolio. You could argue that IOCs are starting to even look like NOCs based on some of the things that they're at least examining from an M&A or an entry standpoint. At the same time, too, I think as we've talked about, a number of the NOCs are looking internationally and looking at large endowments of assets, trying to rapidly become IOCs. So I think at some point you have a bit of a crossover. As to whether that gets accelerated through mergers or acquisitions, I think those are complicated. I think the politics, while I think at various points in time we felt like that the politics might be favorable for such activity, I think it's difficult to contemplate in the environment that we're in right now. However, one can hypothesize that there will be opportunities or potential dynamics occurring in the marketplace that might facilitate such a transaction. And whether that takes the form of upstream, downstream type acquisitions or unbundling and then combinations, or whether it's overall acquisitions is unclear. But clearly the two are converging. I think that, that when you really look and you sit through board meetings on large projects, $5 billion projects, $10 billion projects, and you really don't see much in the way of potential returns from those projects, I think it's a clear indication that there is a lot of overcapacity in the industry, and that needs to be solved in some form. And there's clearly industrial logic. The question, as you highlighted, really deals almost more with the politics than it does either the industrial logic or the financial logic. Controversial topic. Thank you.
Introduce our closing keynote speaker tonight. He's a very distinguished U.S. diplomat. Ambassador Robert Jordan was selected by President Bush to serve as U.S. ambassador to Saudi Arabia at a very critical time, October 2001. Through October 2003. Then he resumed his law career at Baker Botts and currently engages in international business and dispute resolution. He has served as the personal attorney to President George W. Bush and has also advised major corporations in shareholder litigation and antitrust, corporate governance, and dispute resolution matters. Ambassador Jordan.
And I'm really honored to be here today. I want to thank the Baker Institute as well. And the stalwart crowd that has remained for this last presentation of the day. I am always delighted to come back to the Middle East, especially as a private citizen, and especially to places like Dubai and Abu Dhabi, where so much is going on. I want to try to sum up some things that have been discussed today, and my topic is new partnering models. And I think we have heard a great deal today about the changing strategic environment. And these new partnering models, of course, are ways to kind of systematically analyze how we go forward dealing with each other. I did notice, I think in the paper yesterday, that CNOOC has tendered 22 oil and gas blocks for deep water exploration, seeking new technology. And I think that's a good example of what may be happening. We, of course, have heard discussions today about resource nationalism, that the NOCs, Venezuela, of course, the prime example, have in the past forced partners to cede their interests in ventures. The past, of course, is represented by the conventional model of a production sharing agreement, or PSA. And of course, that's a situation in which the IOC has a piece of equity in the project. And this allows the IOC to book the reserves, to increase their resource base, and this, of course, is an important measure of value to Wall Street. But now we're seeing many NOCs unwilling to give equity access to their reserves. We're seeing the IOCs as being viewed as wanting to maximize present returns without incentives for what might be called optimal development of the host country's resources. We see that current partnership models don't really make use of the trends that we've been discussing today in these new strategic relationships. I do think that it's important for us to remember in analyzing these other models that each NOC is different. They're not all created equal. And I also think it's important to remember that each IOC in many ways is different, even though we tend, for statistical purposes, to often lump them all together. The current terms that have been available under these agreements, as I've said, have not been all that attractive to the NOCs. We saw, for example, during the time I was ambassador, the great difficulty that the IOCs had in Saudi Arabia in coming to terms on the Strategic Gas Initiative. These were almost like ships passing in the night, even though it took them, 8 years to pass. We saw the IOCs holding out for their customary rates of return, which were double digits. And we saw the Saudis, on the other hand, insisting that because of what they called a lower risk environment, the IOCs should take a much lower rate of return, which the IOCs in turn called a public utility rate, and they're not in the public utility business, and that's not what their shareholders' appetites have been conditioned to expect. We have seen some of these companies accept a lower rate of return, partly to keep their foot in the door, partly to develop relationships with the NOCs. But the NOCs have a different goal in the final analysis from the IOCs. They want a more long-term view of resource management. This may be an environment in which the IOCs would not want this kind of work. It's a matter, again, of what kind of rate of return they're willing to live with, and we'll come back to that in a minute. So where do we go from here? What are the models that we can look at? The first one I would suggest to you is the service provider model. This would be the role of the service companies, the Halliburtons, Schlumbergers of the world. They can provide a number of these costs at these services at a lower cost than the IOCs. They don't want equity interests. They don't need the customary PSAs. And so the question we might ask is, how would the IOCs adapt to this kind of model? Well, they might be able to provide financial management tools. Morgan Stanley wouldn't like that because they can provide that. The banks wouldn't like it. There are a number of other services that they could provide technical consulting and other things that might be useful to the NOCs. The NOCs, on the other hand, would want to provide some sort of incentives for long-term development of the reservoirs, and it would be very important to the NOCs to not lose the competencies to manage these resources that the IOCs, in partnership with them in the past, have helped provide, at least in many cases. Let's look at a second model, and that would be what I would call the IOC-NOC development model. And this would be a partnership that might be more attractive to the NOCs in the sense of providing social development, training, the kinds of things, frankly, again, that I saw in Saudi Arabia. Many of these developing countries with NOCs very much want job creation. They want the social benefits that their resource richness can provide. We might see the assistance to the NOCs in developing new competencies, minimizing bureaucracy, and helping maximize management skills. Now, there are problems with this. It is not easy to transfer technology. The high-capacity NOC, the ones with real expertise, might not need or want this kind of an arrangement. And it would be very important that the contractual terms that are agreed to by the parties really provide very clearly for the kind of skills transfer that you're talking about here. And you would need a sufficiently robust legal environment and legal regime to feel sufficiently protected in that kind of transfer. One thing that you see that you also, I think, would worry about in this kind of model is the level of trust. Some of the anecdotal evidence is that NOCs don't always trust their partners, and vice versa, I suppose. But if this model is going to work, the market is going to need to revise in a way the way they value IOCs and oil companies. Booking reserves may not be the way to do it in the future. And so this will be an issue that the IOCs are going to have to deal with. The third model would be NOC-NOC partnerships, in which two NOCs join together to share their resources, their expertise. And again, there's probably about as much distrust between NOCs as there is between the other kinds of providers as well. Some have better capacity than others. Again, I think, though, the NOCs would be more interested in investment by foreign NOCs to some degree than IOCs. There have been some upstream deals that have reflected this. Again, this would provide a lower rate of return than the IOCs are used to, but it might get the job done. We have seen the Chinese and the Russians interested in the Saudi gas tenders, for example. Again, they're willing to take a lower rate of return. This also helps the NOC and its host and its parent country diversify political relationships. And there's a tremendous intertwining, as we've seen, between the interests of the NOCs and the political environment of the country. The Chinese, by the way, have been especially competitive in this area because they have been able to develop less expensive technical solutions. We have seen service companies in China and Malaysia that have been very strong, very up and coming, and they have even worked in outsourcing from the IOCs in a lot of this work. So there's a lot of growing expertise there. The NOCs are tending to share some information with each other, research and development, and developing technology. The fourth model we might talk about would be the IOC-NOC / private local company joint venture. I think we'll probably be seeing more of these. We're seeing this in the petrochemical and refining areas, for example. There is a question here, though, about whether the private sector has staying power in downstream investments. If you have a private domestic equity partner, this might be more politically attractive to the host country that has the NOC. So you could envision models of a merchant family joining as a private sector participant with the NOC of their country and perhaps an IOC, and I suppose even another NOC, in a partnership model along those lines. This, of course, would still likely not apply to the upstream sector, which would remain off limits. But it does put a local face on the investment and the project. The fifth model that we would then look at would be the IOC, NOC joint venture in a third country, and we saw some of that in the discussions earlier today. And I think you can summarize that by saying that it does aid the NOC, one or both of them, in management skill building and in technology. You still have issues of state resource management, but they are not as predominant. And you see that through this mechanism, the NOCs can actually show the IOCs their own competencies. Petrobras comes to mind as one that has been particularly successful in that area. Now, the IOC in this environment does risk their reputation if they're not dealing with a first-class and strong NOC partner. And there are, however, some NOCs that have real advantages in dealing in these third countries. We have seen Muslim countries that seem to have an especially smooth entree to other Muslim countries around the world. Political relationships are also often equally relevant. But it can also be a disadvantage. Certain of these NOCs from these countries, for example, might have a harder time doing a project in Europe. The sixth and almost final model would be the IOC-NOC strategic alliance down the supply chain. And so you would see, and we're seeing a lot of this now, power generation, natural gas sectors we've discussed, pipelines, tankers, terminals, and so forth. As we begin to see gas replacing oil in use for domestic consumption in the countries of the NOCs and increased gas exports, there may be some additional opportunities in this area. The NOCs in the importing countries, of course, will also be very interested in these opportunities, especially in Asia. The Chinook situation would be one, for example, where they have given rights to a regasification terminal in exchange for access to upstream developments abroad. There have also been perhaps suggested asset swaps. You might exchange a % of interest in one field for interests in other fields elsewhere. I think we've seen Sonatrach and Statoil reflecting this potential model. Question, and that is where the NOC purchases an IOC or perhaps an independent company, and perhaps then becomes, as was mentioned, a super NOC. The NOC would get access to the technology and skills available. They would have more international exposure, which can be good or bad depending on how the exposure plays out. This would undoubtedly require, at least in the early stages of a model like this, the acquisition of a smaller IOC in most instances. You can anticipate, as was inferred in the last exchange, political resistance. We certainly saw that in the Chinook-Unocal transaction. In a way, you could call that resource nationalism in reverse. That was political resource nationalism. That's probably the kindest face you can put on it. Secretary Baker last night said it was a national embarrassment. Actually, he was talking about the Dubai ports fiasco, but I think the Chinook experience with Unocal would be very similar. There has been some talk that perhaps some of the independents or private companies in Canada might be ripe for acquisition by a national oil company, and so I think that's going to be a very interesting course to follow as well. So finally, in summary, I think we're seeing a changing role of both NOCs and IOCs as we've seen throughout the day today. There is an opportunity here, I think, for the service companies to come in and play a very significant role in a growing market for them. And it's a challenge, as we've seen all day today as well, for the IOCs to keep their rate of return or to convince the markets and their shareholders that some of these new models really would work and there is still a good financial future for them. Thanks very much.
Well, it's been a pleasure visiting with you all this afternoon, and I thank our die-hard audience members for sticking with us and hearing these very interesting afternoon presentations. Just a few details, a few house-cleaning details. The entire Baker Institute study is posted on our website, which is www.bakerinstitute.org. Or if you want to take the backdoor energy shortcut, www.rice.edu/energy. We will be revising the study to finalize it into a book volume, and we encourage all of you to contact us by email. If you didn't grab our cards, the emails are also on the website, to let us know your thoughts and feedback. It's very much a work in progress, and we look forward to having a dialogue on that. The slides from today's presentation, a webcast from today's presentation, and then for those of you who didn't hit the Houston conference, also materials for the Houston conference are also on the website. So I want to thank all of you. I want to thank again our conference sponsors, Accenture, Morgan Stanley, Saudi Aramco, Baker Botts LLP, and JPEC. For their generosity in supporting today's program, and we look forward to seeing you all again back here in the Middle East. I think we have concluded that this is a great venue, and we like taking our show on the road here to the Middle East. We thank you all for your hospitality and your time, and we look forward to seeing you soon.